Welcome to Investors Insights, where today's topic is fund flows. A lot going on this week. I'm going to talk about how the markets react when the Fed pauses its rate hiking. Ty is going to talk about income migration, a very interesting topic from Ty, so make sure you stay tuned. But first, Trey, talk about the Fed. The Fed meets this week on the market. A lot of eyes are looking at the Fed to see what policy changes they will make. Talk about the Fed and what we're looking at.
Yeah, absolutely. Thanks, Bobby. So the Federal Reserve Open Market Committee is going to meet today on the 2nd and 3rd of May, and they're going to make their announcement. And the market pretty much expects that they're going to raise rates 25 basis points. And then that's going to be it. So they're going to be moving the federal funds rate from a high end of 5 to a high end of 5.25, which will put it above the current inflation rate, which is 5. This is something we've been anticipating since the Fed started hiking rates. They needed to get that Fed funds rate above the rate of inflation pause. But so now that the market pretty much priced that in, it's not just what the Fed does, it's what they say they're going to do. Do they telegraph that this is it? We're going to pause for a while. We're going to see where this goes. And then secondly, the way that the Fed reduces inflation, or way that they're trying to reduce inflation, I'll say that, trying to reduce inflation. They have two tools. One is what they're doing, they're raising interest rates. The other is their balance sheet, which is where they expanded their balance sheet and bought assets during COVID to the tune of around $9 trillion. And that was extremely inflationary. They did that to try to stop the collapse potentially of the financial system during that time. However, they've got to reduce that balance sheet down. And they've been doing that all throughout 2022. So they're taking that $9 trillion down. However, if you can see in this chart, they had to reverse that course and actually put money back into the system when Silicon Valley Bank failed back in March. You can see here, the Federal Reserve balance sheet went from roughly 8.3 trillion all the way up to 8.7 trillion in the weeks following the Silicon Valley Bank failure. Why is that important right now? One, that is putting liquidity back into the system, which is inflationary. It does support the banking system. But two, over the weekend, we got news that another California bank, this time First Republic Bank, is going into receivership by the FDIC, and JP Morgan will be taking them over. This is not a recommendation of either bank. Obviously, wouldn't recommend First Republic Bank because it's no longer a going concern, but this is not a recommendation of JP Morgan. It's just the news out that another large West Coast bank is failing is going to muddy the waters on what the Fed can do. The Fed would like to have its balance sheet drop, but they couldn't do it last time because they had to come in and save the banking system. Are they going to have to do that again? And so with this happening so close to the Fed meeting, I'm sure they're going to get a lot of questions. So that's going to be very telling to what the Fed chairperson says about what they're looking at now that they have another West Coast bank kind of in receivership. So very interesting timing, a lot to go over, a very big week for the Federal Reserve just in 2 days. And the all-important press conference will be where we get all the information.
Yeah, and with the Fed expected to raise rates another 0.25% this week, the question now is, will they announce that this is the last rate hike? So what we want to do is we want to take a look back at how the market has historically performed after the Fed pauses. And as you can see in this chart, the S&P 500 has been up 6 out of the 8 past times 1 year after the Fed pauses its rate hiking, and up an average of 13%. So while this chart might give investors a lot to look forward to, it's actually important to know the details. And unfortunately, the 2 years that were negative that you can see in this chart were 1974 and 2000, which were years more similar to what the market and the economy is experiencing this year with higher inflation. So while buying stocks has worked in most years after the Fed pauses, we're more cautious this year because of the higher inflationary environment that has led to lower returns in previous cycles. So obviously, as Trey said, and as this chart shows, we're watching the Fed carefully this week. But Ty, talk about a different topic, a very interesting topic, and about income migration.
So on Thursday, we got the official numbers. It's something that, I think we all kind of knew that there was a great migration during COVID from high tax states and from, big cities that were shutting down, thinking, New York and California specifically, into low or no income tax states like Florida and Texas. And so we got those official numbers, and it's even, bigger than we thought. Florida added $63 billion worth of income during this time period. Palm Beach County alone added $11.4 billion. That was more than every state other than Florida and Texas. Meanwhile, on the other side, California and New York, Trey's talking about, a lot of the bank failures here. They're mainly tied into the California area, somewhat New York. We do know that that's a lot of interest rate risk. However, it's probably hard to get deposits when $47 billion is leaving your state, California, and $44 billion leaving New York. Manhattan alone losing $31 billion. These are big numbers that are flooding into these states. Our office, of course, is in Alabama. We were a little bit of a net gainer here. In fact, during this time, the 10 lowest state income taxes states added 100 billion. The 10 highest lost about 100 billion. It's basically a direct, trade-off. That pace actually out doubled, what the previous pace was. So, this is a big deal. And these are high net worth clients. The average tax return in Florida was up $80,000 just per person. This is a big deal. And this is something that's going to change the landscape for schools, for employment. Headquarters are moving to this. So California and New York and other high income tax states are going to have a decision on their hand. Do we lower taxes or do we, continue to try to fight this battle?
And this also makes the Fed's job harder because you've got California and New York are much slower economies than Florida and Texas. So how does the Federal Reserve treat one state differently than the other? You would think that they would want to stimulate the California economy, which is what they're doing by supporting those banks, while also slowing down the Florida economy. So it makes the Fed that has to make decisions for a whole nation, makes that job a lot harder when the returns of states are doing so differently. So it definitely makes that threading the needle of inflation much more difficult.
Yeah, so a lot going on this week. Our eyes and attention will be on how the market reacts to the Fed decision on Wednesday. More importantly, what the Fed says at the press conference and what policy changes might impact the economy and the market. So a lot going on. If you have any questions on anything we've discussed here or what happens with the Fed this week, please reach out to us, call us, email us. We love to hear from you. And we hope everyone has a great week. Thanks.